Hello, welcome back to another edition of Leadership with Darrell W. Gunter. I am so pleased to have a returning guest. This is his third time, really the fourth time for one of his companies to be on our show, Mr. David S. Rose, who is the founder and CEO of USREM. He's the founder and executive chairman of Gust.com. He's the founder and chairman of emeritus of the New York Angels. David S. Rose sits at a rare intersection of multi-generational real estate expertise, venture capital, and technology platform building. Often described as New York's archangel, David has helped shape Silicon Alley in New York while now addressing one of real estate's most persistent challenges, illiquidity. David, welcome back to the program.
It's a pleasure to be here. It's been quite a while. God, four times. I feel like an old pro.
Well, since 2009, so that's that. I got to get you every 5 years. So, what we're going to explore today is the leadership journey, your leadership journey, and also the thinking behind USREM, which is a marketplace designed to bring flexibility and liquidity to private commercial real estate. So, you're a fifth generation real estate entrepreneur, yet you're also known as a foundational figure in New York's technology and venture ecosystem. Who were the key influencers, family mentors, or experiences that pushed you to merge traditional real estate with venture style innovation?
Well, I actually completely lucked out on this one, and this is nothing I can take credit for, but I had the absolute perfect confluence of events. I was remarkably privileged to be the great nephew of the first David Rose, after whom I was named. And that David Rose was actually born in Palestine back in the day in Jerusalem. Came to the US when he was 10 years old with his older brother, my grandfather. And the two of them grew up in the Lower East Side, didn't get out of sixth grade in school, were self-taught, started a business, became a real estate business that is still going strong. This is its 100th year. So for 100 years, the family real estate business has been going strong. And my Uncle Dave was not only an entrepreneurial type himself, but he, having gotten to a point in life where he had resources, decided that he could contribute to society by finding really interesting ideas and funding them. And so he was an active angel investor from the 1950s on, which makes him one of the earliest angels before the term was even coined. The term angel was applied to people who invest in businesses in the 1970s, coming out of the Broadway theater. But this was the guy who was the angel investor behind the portable kidney dialysis unit, vascular stapling, hyperbaric operating chambers, concrete boats, desalination projects. It's a guy who personally invented through the wall air conditioning. And so I grew up as a teenager and then a college student, having lunch with him and listening to his stories about these companies that he was helping to fund. When the artificial heart first came around, he actually had one on his desk, and he said, "Oh, look, here's," because the same guy who was doing the kidney dialysis unit, that was the same lab that was doing the artificial heart. So it was interesting because back then this was not angel investing as we know it today or TV shows. It was a weird thing, and everybody thought he was nuts, and everybody thought that this was, I mean, there's business, and then he's doing this crazy stuff on the side. So he was dismissed out of hand literally by everybody. But I found this fascinating. One time he invited me to come in for lunch when I was in college, and I came to lunch and realized there were several other people there, which was a shame because I love talking to him personally. But then I looked around and it turned out that the other four people at the table were four Nobel laureates.
Oh
So it
my
was me,
goodness.
Dave, and four Nobel, Rosalind Yallo, Robbie Murray. I mean, an incredible guy. So I start with that as my great uncle. And then my father was, who grew up and worked in the real estate business with him, was a total entrepreneur. As a matter of fact, I was a finalist for the E&Y Entrepreneur of the Year award back during the dot-com boom in 1997. My
Mhm.
father won it in 2002 as the E&Y Entrepreneur of the Year in real estate. So
Wow.
he is now 96 and going strong. He's working on his third book. His first book was a Kirkus 50 Best Books of the Year book. He's developing a museum in Accra, Ghana. He is doing all kinds of stuff. We went out to the opera last night. So at 96, so I got these incredible role models of folks who are entrepreneurial, active in supporting other kinds of companies in real estate and in startups. So you don't get any better background than that.
Oh my goodness. Wow. I tell you. But I've met you some years ago in the Cody competition, and I've always found you to be so inviting and humble and respectful.
Not sure anybody in my family would agree with that particular definition. I come from a family of non-humble people, um, but I like to joke that my ego is so big you can't get on top of it. Somebody like our current president has a big ego, but he's always afraid there's somebody better than him. I'm
Right.
just so convinced of my own goodness that I can't be patronized. So it's easy to be humble.
So, having led the New York Angels, and you have backed hundreds of startups, and you're now running a fintech-enabled real estate marketplace, who do you see as your primary stakeholder today? The traditional real estate sponsor or the tech-enabled investor seeking liquidity and optionality?
It's actually both and neither. What we are doing with USREM is creating a platform, a marketplace for qualified purchasers. Those are the level above accredited investors. So they're people with at least 5 million in assets. So it's a very rarefied world. But these are the people who are currently investing
Mhm.
in real estate, privately owned, professionally managed real estate. In other words, where you invest in real estate that somebody else manages as opposed to you yourself, or you're a limited partner in a deal. That's a $2 trillion marketplace in the United States. There's 2 trillion of privately owned, professionally managed real estate. And so all the people who invest in that, these are the LPs or limited partners who do that. And because real estate's a long-term asset, the capital that goes into real estate is long-term capital. And so typically when as an LP, you invest in a real estate syndicate or a fund with multiple properties in there privately, everybody understands this is a long-term investment. Your capital is coming in. It's typically pro forma to 5, 7, 10, 12 years, during which time you get often quarterly distributions of cash from the cash flow of the property. And then at the end of that, the sponsor, the general partner, sells the property. And then you at a hopefully appreciated value because they made it better or markets better or whatever. And you get your initial cash back plus an increase in value. And so therefore it's like a double bite. You get the cash flows over time, and then when the property is sold at the end, you get a big chunk of cash. But however, the one thing, whether you're investing in multifamily apartment buildings or office buildings or data centers or whatever, is that this is long-term capital, which means it's illiquid. Your money goes in, and like a Roach Motel, it doesn't come out until the end. And so this illiquidity is what everybody understands going in. That's why you're getting these kind of high returns because it is locked up. And that would be fine, except that in the real world, life happens. And in life, that means you're getting divorced or you croak and your estate has to deal with it, or you have a capital call from somewhere else and all of a sudden you need cash or whatever, but you need cash. You look around, you have this big chunk sitting in real estate and yeah, oh, that's a good chunk. And you go to the GP and you say, hey, can you buy me out, please? Let me get my cash back. And the GP will typically say, I empathize, Darrell, but no, that's not the way this works. Your cash is in. And so if the LP really needs the cash, they jump up and down and make a scene or beg and plead, the GP will finally say, okay, listen, I can't buy out, but if you can find somebody else to step into your shoes and take care of it, even though I don't have to, I will allow them to step in and replace you. So now you're left with a random dude with a random piece of a random syndicate that can't be further resold, trying to find a buyer in something for which there's no marketplace. Good luck with that, right? So yeah, if you're a big enough portfolio, you got $100 million, asset or something, there are secondary funds by big players, Blackstone and others, who will take that out. But if you're a normal, QP, HNW person, you have $1 million investment or a $500,000 investment, $100,000 investment in a random syndicate and a building in San Diego, there's no way you're getting liquidity. And so this is a problem. A $2 trillion marketplace, this is a problem. And so it's a problem not just for the LPs who need liquidity, it's a problem for the GP who now has a disgruntled, LP who wants to get out. And when they're raising funds, it's harder to raise funds if what you're getting into is illiquid. And so the GPs see this as a way to add value to their property, because if it's liquid, actually adding liquidity to a real estate deal has been proven to increase the value of that property by 12 to 22% with an average of 16%. So as far as the GP is concerned, if they can make their property more liquid, it increases it in value. As far as the LP, the limited partner who is investing in this, if all of a sudden they can sell their asset, they have the optionality of liquidity. That's great. So our, two sides of our market are the sponsors, the general partners of these real estate syndicates and funds, and the investors who invest in them.
Wow. So, with your urban studies degree from Yale and your MBA in real estate from Columbia, this has helped you shape your early conviction that real estate, despite its size, was technologically behind and ready for disruption. When did it first hit you that, okay, I've known about this problem for a while. Now allow me to put forth some technology to address it?
Well, it's interesting. First, again, I lucked out in terms of Yale. I went to Yale because Yale had an urban studies program, and that I knew that's what I wanted to do. So I get to Yale the year they abolished the program. Okay, so I had to create my own divisional major in urban studies, which I did. And my advisor was a wonderful guy named Alexander Garvin, who was the dean of urban planning. He wrote the major textbooks on this subject, and he taught study of the city at Yale for decades. And so I ended up working for him as his intern my summer of my freshman year in college,
Mm,
and so he was a very rational, pragmatic kind of guy, and I got a lot of stuff from him. But eventually, when I got into the real, so my first job out of college was in urban studies and politics, working for Senator Moynihan, Daniel
huh,
Patrick Moynihan, as his urban affairs expert, and then running his regional office. After a couple of years, I decided I was having too much fun, and besides, I was really a private sector kind of guy. So
right.
I left Moynihan and got my MBA at Columbia in real estate finance, and went into the family business in real estate. And so here I was, this young whippersnapper coming in. This is 1980, 81, into real estate, not being a coder or a techie, but being a technologist. So I really was, understood technology and looked at this industry and said, oh, this is a little bit backward over here. Just think of all the things you could do with these newfangled computers coming in, right? Remember the Apple II was introduced in 1979, right?
Right. That's right.
So they were brand new. Nobody had computers, desktop computers. And I said, well, that's of course, if you're starting a new role, the way you'd use AI today, right? Well, logically, I'll use a computer. So that gives me the dubious distinction of actually having invented the field of prop tech. So I have literally, I have been a prop tech, person since the early 1980s.
Wow.
And in that time, I created the first computerized real estate sales office, got a full page info world in 1982, the first
Ooh,
multiple listing service for New York, the first construction punch list software for buildings, we did the first buildings that came with a computer in every apartment as a sales feature for your condos. And then since I had a building full of computers, we were the first people to create a location-based social network, a building network for people in the building before there was an internet. We did the first webcams for construction progress photos, the first
goodness.
the first shared tenant telecommunication systems. So basically, having you asked, when did I realize that there's a thing called prop tech? Well, I invented prop tech, back in the 80s. And so, and then the question was, well, why isn't anybody else doing this? What's what's
Right.
what's going
Right.
on here? And so, it only took about another 30 or 40 years before people got around to doing this kind of stuff. So now prop tech, real estate technology is a big industry. There are prop tech accelerators like NAR Reach and Metaprop here in New York. There's the Prop Tech Council and so on. I'm on the technology committee for the Real Estate Board of New York. So it became, as a rational person who was open to new things, you look at an industry that's doing great things, but is a little behind the times, and you say, hey, you can use this new technology. So that's what we're seeing now. It's very slowly, but prop tech, real estate technology is getting to be a thing. People are applying computers and AI across the board. It's still slower than most other industries, but it's getting there.
So this problem, as you said, this is a multi-trillion dollar marketplace, and you've just announced it. I'm sure you had an early super user group. What did they say to you, David? This is fantastic. This is awesome.
Well, what's interesting is there have been probably 30 or 40 attempts at doing things in this space. And so when you're talking to anybody in the venture world, they say, well, how come it hasn't been done before? What happened? Why did everybody else fail in here? And the problem was that everybody else who tried these things, and there have been a lot. I was actually one of the very first investors in a company called Realty Mogul, which was one of the first real estate crowdfunding platforms,
Mhm.
venture backed and great company. The challenge, however, with all these companies is they were either looking to democratize capital, let the little person invest like Donald Trump or whatever. And if we can make it accessible by dividing it into small pieces and making it easy to trade, you can, like Robinhood for stocks, you can now invest in real estate. Turns out that's not the problem. If you're a retail investor and you want to invest in real estate, you can invest in a publicly traded REIT. That's what the stock market is for, with $100 investment. But the kind of things we're talking about are the average investments here are in
Yes.
the hundreds of thousands to low millions. It's a very different kind of a market. And so because real estate is non-standardized, everything is different. You got to analyze each particular property. It does not lend itself to crowdfunding, and every single one of those died. Okay. The next group that came around were all of the blockchain, super cool, techno tokenized, let's tokenize real world assets and make this great. I happen to be a great believer in the future of tokenization, in the future of tokenizing real world assets and blockchain. However, we actually started out USREM with a blockchain basis and went
Okay.
around started talking to folks in the real estate industry, and they said, "Ha! Tokenization, no, go away. We don't want to hear about blockchain." It turned out that they were not at all ready for it. And then on reflection, it turns out that not only were they ready for it, but there was zero need for it for the kind of stuff we were doing. Real estate is a slow moving because of all the other things around, right? And so
Mhm.
here you had a whole bunch of companies trying to do blockchain and tokenize real estate technology coming from the blockchain industry. When all you have is a hammer, everything looks like a nail. When you have a blockchain tokenization solution, you want to go to apply it to everything. And real estate didn't need it, didn't want it, couldn't care, and it didn't match anybody's needs for. You're not going to day trade real estate. You're not going to. It's not speculative. It's a 40-year mortgage is sitting out there for forever, right? So the whole tokenization stuff blew up and fell apart. Nobody did that. All right. The third group of people who tried something were actually closer to the mark. And these were folks who were saying, oh, there's a secondary liquidity problem here. Let's have a marketplace for LPs who want to move their, get liquidity on their holdings to come list their stuff. Okay, right church, wrong pew. The problem there was if you start with the LP doesn't have the right to sell their thing without the GP's approval. So that doesn't work unless you get the GP involved, number one. And number two, if you wait around for people to bring their things to you to sell, then you end up with a sort of mishmash of a site which has whatever the special is today, hamburger today and bananas tomorrow, an oddball piece of this and an oddball piece of that. And that's not anything anybody rational wants to buy. So what we are doing is creating a permanent market like the New York Stock Exchange effectively, right? Except it's not a publicly traded equities market. And so here we start out by working with the GP, the sponsor, who says, oh, this is great. I want to add liquidity to my property, my fund, and support my LPs so they can get liquidity and change. So we're starting with that means that everybody, all of the LPs are already pre-approved to sell their
Right.
things. And the sponsor gives us all the information we need for diligence and so on and so forth, and introduces us to all their LPs and says, hey, here's this, now you have an option, you can, list your shares there. So by starting with the GPs, by getting access to them to all the LPs, by creating a permanent marketplace, so they know that they can always go there to find at some price a buyer, and buyers know they can, like in the stock exchange, they can always come and find a seller at some price, right? So by having a permanent market designed for qualified purchasers, it's above accredited investors, and working with GPs, we think we have found the magic key to the problem.
And if it's okay, if you feel comfortable to share your business model, um,
Sure.
how does
In order to do this and make money off it, you have to be able to take commissions on a transaction. To take commissions on a transaction, this isn't a real estate brokerage transaction because we're not selling buildings. We're facilitating the sale of shares of interest in these things, and that's a security, which means the only way you can legitimately take commissions on a security sale which every startup should know but doesn't, is through being a broker dealer. So that meant we had to go out and become an SEC FINRA registered broker dealer, which we are. USREM Securities LLC is our
Mhm.
wholly owned broker dealer. And so we get commissions on these sales. And typically for a secondary transaction, it'll be 2.5% from the buyer and seller. Which is not exorbitant. And if we can facilitate you finding liquidity and at some number, that's a pretty good deal. And so the sponsor pays us a commission if it's a new fund they're raising, and people find like an IPO, people find it through the platform. And on the secondary sale, it doesn't cost the sponsor anything, but the buyer and seller each pay 2.5%.
Wow, that is awesome. And how long did it take you from start to finish uh to this launch that you announced this week?
You don't want to know, or I don't want to tell you, but it literally it took us 5 years, which sounds crazy. But
No?
in part defense, we had COVID,
Right,
which hit,
right, right.
just after we had gotten started, and then we had to do the whole broker dealer thing, which is completely non-trivial, right? And then we had to line up properties, and we had to, so it took a lot of work to get here. But I'm delighted we're now live and launching. So.
Wow, this is awesome. So you currently have over 1 billion in property listed. What type of assets dominate the platform today? Is it multifamily? Is
Yep.
it
So so
office
so today it's
retail?
interesting. Today it's primarily multifamily. We have some office.
Mhm.
We have a bunch of things, but we have primarily multifamily in the form of either apartment buildings
Mhm.
or like townhouse communities.
Yes, yes.
High-end communities there.
Mhm.
And but we also have triple net lease retail space, which is very rock solid. That's almost like a bond. You have a tenant. It's a triple net lease, and you just sit back and collect the funds on that. We have a number of funds. We have an affordable housing fund, which invests in affordable housing. We have a workforce housing fund, which effectively is a fund of single family homes. They go out and acquire single family homes, which they then lease. Interesting question as to what happens to that part of the universe now that the president has just forbidden or is proposing to forbid that. We'll
Right,
see if that goes through, what that means, what the ramifications are. I'm not sure it's actually legally sort of can go through, but we'll see.
right.
But so right now, I would say that most of the stuff on it has to do with either multifamily or funds of single family homes. We have a couple of office properties on there, and over time we're going to be having industrial and data centers and new developments and stuff as well.
A
And,
data
and
center.
hotels. We have a hotel coming on too. So
Oh, congratulations on that. And so when you look at the illiquidity problem, um, how does the market respond to that? Was the market even aware that this was
well, the
actually a
market was
problem?
aware there was a problem. LPs know there is
Yeah,
a
the
problem.
LPs, right?
Right? And GPs, everybody's big question was, well, GPs typically want to play things very close to the vest. They don't want to let anybody know there. They don't want to, they can control the LPs so they can, say, if you want to sell it back, I'll buy it from you from pennies on the dollar because they
Right.
have unilateral control. They can refuse to let the LPs sell, right? So we were curious about what would happen when we approached the GPs. And it turned out the results were one of the few really surprising things in my entrepreneurial career. First of all, relative to the question of, oh, I have the right to buy pennies in the dollar because, they have no other choice. When I was on a very interesting call with a sponsor and his attorney, we were going through the paperwork, and the attorney was saying, John, why do you want to do this? You can force him to sell you at a low number. To which the sponsor said to his lawyer, are you crazy? If I'm telling him it's worth here and I'm only buying it over here, that makes me talk down my own portfolio and screw my own user. And I want them to come back and invest in my next deal. Why would I ever want to do that? I would just as soon they find somebody else to step in and take it because my business is not buying that. So that's number one. So it turned out that there are two types of GPs. One type of GP has a captive LP, a big, large institutional LP, or it's their family members and so on and so forth. They looked at this and said, oh, very interesting idea about providing liquidity. Not really for us because we don't have liquidity needs, but we love the platform. So can we invest in it? So our entire seed funding round has come from the biggest names in real estate in the East Coast. And then the second group turns out to be people, sponsors who go out and raise funds for their syndicates or their funds from through agents and placement agents and the like and random people. And they said, This is a no-brainer. What's not to like? Where do I sign? I mean,
Right.
and literally, it was the best product market fit I have seen in my entire career of finding GPs who have, anywhere from, 25 to 100 LPs saying, wow, this will let me raise funds easier. It'll make the story better, even if I don't raise it through you. It'll provide liquidity for my end users. It'll make the property more valuable. What's not to love?
It's not to love. Wow. And where can people go to the website? I don't want to assume the website, but
That's great. USREMsecurities.com. No spaces. USREMSECURITIES.com.
beautiful, beautiful. And David, what's next for you? I mean, you're every time I turn around, you got something new, great going. But you're just going to focus on this to get this off the ground, or do you
No,
have something else cooking?
unfortunately, I'm an entrepreneur and an angel investor and a bunch of other things, as you know, as well.
Right.
So this is my day job to which I devote all of my waking hours and half of my nights. But in the remaining other half of my nights, I'm also still executive chairman of Gust, which is the platform
Yes.
that
Yeah.
connects 2 million founders and most of the major angel groups in the world. I
Yep.
happen to chair an artificial intelligence company called Thinkable AI, which has got a new thing called Plot which is the first completely AI-based screenwriting and trailer production operation. I'm the chairman of the board of a company called Book It and Go, which is an AI-based travel agency platform. I've just published the second editions of my first book, Angel Investing,
Yes.
which came out a couple months ago, and the second edition of the Startup Checklist, which is designed for founders. I just turned into the editors last week, and so that'll be out in the early spring. And then I just signed with Wiley to do a third book called The Real Estate Investing Bible, 25 Strategies from the Industry's Top Leaders, which will be coming out hopefully either late in 26 or early 2027. And then I do a bunch of other things on the side as well. So,
Of course. It's interesting when I'm advising startups, of course, the books I refer to them is the startup checklist as well as angel investing, but also you have a PowerPoint that's up on YouTube about what you should present to a
oh, that's a TED talk. I did that. That's an interesting TED talk called How to Pitch a VC. It's
yeah.
been viewed something like 2 million times, some crazy number of times. And so it's a really good introduction to pitching. I've since done a bunch of other things on the topic. And for those of your viewers and listeners who are startup founders interested in getting financed, I've got something. Check on YouTube for fundraising 101 with David S. Rose. And that's a sort of an hour-long thing explaining how the whole early stage startup fundraising world works. And it would be a great level setting, context setting play to let you then go out and do your pitch and raise funds.
If I may ask, and we have a couple minutes left, what is the two or three mistakes that entrepreneurs make when they're pitching for an investment?
Well, so the interesting thing is most entrepreneurs make mistakes because they don't know how the industry works, right? And therefore that's why I'm suggesting the fundraising 101, which will give you that concise understanding of what we're looking for and how we're thinking, right? So if a founder comes in and tells you, oh, this can't lose. What do you mean it can't lose? The vast majority of things fail. You will make $1 zillion. You can't tell me what I'm going to make. You don't know how, what my economics are or anything else. You can't guarantee it's a hit. We have no competition. Well, if you have no competition at all, that means nobody's interest has ever thought about solving a problem you're solving, and there's no problem, so I'm not going to invest. And on the other hand, you probably do have competition, and if so, you're either not telling me about it or you don't know about it, right? So that you have competition. You saying we're going to make $100 million in our first year. No, you're not. So it all comes down to being realistic. The kinds of things that investors are looking for when they look at a startup are really they're rational, they're normal. If you've done this before, you have a pretty good handle on how much it'll take to get a company going, what kind of universe of revenues are likely to be in, what valuations really generally should be to make it all work out, what kind of team they're likely to need. You want to see some traction. So to do all this, and that's what I call the sort of mil spec standardized thing. And then it's a question of for every company that comes in within that envelope, You want to say, okay, does it meet my thesis for this industry or this stage or this size or whatever, right? But and every time you go outside of that standardized stuff, we're not going to be a Delaware C Corp. We're going to be a Guatemala partnership. No, bam. We're going to be, I've got, 500 non-accredited investors in my captive. Bam. Oh, I have two shares of stock. I have two kinds of stock. I got founder stock, which lets me control the bam. Oh, I'm raising at $100 million valuation. Bah, oh, I only need to raise, $2,000. Bah. So basically, every time you do something that is one standard deviation from normality, from the mean, you make it twice as hard to raise funds for what you're doing. So
Great. Ladies and gentlemen, we are here with Mr. David S. Rose, the founder and CEO of USREM. David, thank you for coming on the program.
it's my pleasure.
That wraps it up this week on Leadership with Darrell W. Gunter. We want you to have a great day, but remember, leadership begins with you.